Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore. How we doing today, guys?
Hanging in there.
Yeah, doing well. Thanks.
Doing well. Well, very good. The year's off to a good start. I guess we're mid-January. It'll probably be beginning of February by the time this comes out. And year's starting off pretty good, huh?
Decent, yeah.
Absolutely. January is a long month, but we're here.
Yeah, funny. Markets have been super calm for a long time until it was actually yesterday where we had a little bit of kind of volatility. But I think today what we had talked about discussing on the podcast is when you go out and you look at financial advisors, a lot of times advisors are kind of branding themselves in a certain way. And a big one that's kind of popular in the industry right now is to be a personal CFO. And other people say it's almost becoming cliche, but I love that tagline just because I think it's really descriptive of, what we do for our very best clients. And so today, and I actually put that down on my LinkedIn as personal CFO. I think at least one or two of you guys did too. And I think maybe today we can kind of talk about why do advisors call themselves personal CFOs? What is the role of a CFO in somebody's life, whether you're a company or you're an individual? And then maybe kind of the three facets of where they work, but three facets of kind of a personal CFO's role in a client's life. And I think, when you think about a CFO for a company, a CFO for a company is not just coming in and looking at the balance sheet or looking at the income statement or looking at what they're investing in. They're kind of, for lack of a better word, they're kind of the quarterback of the financial organization, right? Not only that, but a lot of times they're the visionary from a financial standpoint of an organization. And I think as you're an individual that grows your wealth, and maybe you get up to that, I don't know what the threshold is, but a few $1 million. Well, you can kind of take that same concept of hiring a CFO or somebody that can kind of quarterback the entire situation. And what that means is it's someone that's not just focused on, and you're not segmenting, investment management, estate planning, tax management, and all the different things that go into your financial life. So I think today, and the three of us got together earlier this week and really segmented it down to those three main categories. And I think we can each touch on one of them. But the categories are, when you have a personal CFO, they're going to definitely deal with your investment management. And that's what people typically hire a financial advisor for. And probably the number one thing that they think about when they think about a financial advisor. But there's also tax management, which is so important. And then when you look at the whole thing and kind of wrap it up into an estate plan, that's really a personal CFO's job to quarterback all three of those situations. So maybe we can each take, and I think Eric's going to talk about investment management, Ethan, tax management, and then I'll hit on estate planning a little bit. But why don't we go ahead and start? And what do you guys want to talk about first? Are we going investment management or tax management?
Well, it is tax season.
It is tax season. Let's go tax management. Let's do it.
All right. Yeah. So it's very clear that, and we want to make this clear, that we're not filing taxes. We're not doing the compliance portion of tax management. We're here to really focus on what's ahead. There's a lot of times when people talk about taxes and tax planning, even you'll hear tax planning say, "Oh yeah, I'm covered. I meet with my CPA in April." And sure, there's value to that, but it's too late. When you sit down and meet with that CPA, whatever happened in 2025, for instance, that's already taken care of. You can make a contribution to an account, depending on the account and how it's titled and registered, that will take advantage of the 2025 tax year. But that's kind of the extent as to what you can do after the time has already passed. So sitting down with people, not only in just April, but June, July, August, September, and focusing on, hey, what have we done so far in this year? What can we do to help bring taxes down or just understand tax strategy moving forward. We think that's a huge component to tax management. Asset location, coordination of investments in tax strategy. So you look at things you do on the investment side and how they affect what occurs on the tax side of the equation. So if we're doing Roth conversions for a client, that's a huge tax management strategy. What that is we're taking an IRA and we're converting that over to Roth in that tax year, and we're paying taxes as we convert rather than just paying a huge tax down the road when RMDs occur. When you do those Roth conversions, there are other things that will affect. Depending on how aggressive you are, it might affect your Medicare premiums that you pay. So if you jump into the next tax bracket because you're doing a Roth conversion, your Medicare premiums might go from $185 a month to $275 a month. And are you okay with that? So just making sure you're planning and understanding the consequences of doing some of these tax strategies. Tax efficient asset location, we think is important as well. So there's some things you can get away from and some things you can't get away from. So making sure that your taxable accounts have tax efficient investments in them, like ETFs. And then your Roths are invested more aggressively than your other accounts because there's no RMDs in your Roth, so we can let those things grow as long as we'd like. So just different little things along the way that we can kind of uncover as far as tax planning is concerned. The last big one that we really like to take advantage of is just capital gains planning. You might have owned a security for, 10 years. You got a really big gain inside of there, but then you might have a huge loss in another security in that portfolio. And we like to couple tax loss harvesting into our tax management strategies. So making sure we're just understanding our client's whole tax picture. Because there might be a year where you sell a business or you sell an investment property and you got a large capital gain on your books. Well, we can help offset that using some tax strategies on the investment side. So just making sure everything's talking to each other. And Jeb did a good job of illustrating they're kind of pillars, or we call them legs on a bar stool. They're all going to work in one way or another, making sure we're talking and everything's kind of working in conjunction. I think it's how you get the most value from the personal CFO side as far as tax management is concerned.
Yeah, absolutely. I mean, that's what a personal CFO does, is they collaborate with all the different facets of your life, all of your wealth management. So obviously a big part of that also is investment management. And kind of want to take a second and, kind of frame this here a little bit where, investment management certainly isn't about chasing returns, but it's about supporting real life goals. And when you come up with a question or rephrase the question, that gets asked, what did my portfolio return? And maybe a better question is to ask, is my portfolio helping me live the life that I want now and in the future? And I think that mindset, when it comes to investment management for us, really has also evolved over time. And it's really focused on kind of three things, like how do we build the portfolios? How do we manage the risk? And how do we behave during market volatility? You answer those three questions, you're going to be well off. You're going to set a portfolio up for success, which obviously sets up the client for success. And a couple things to keep in mind, every portfolio and every investment has a job to do. Some of those investments are long-term. Those might be assets that are in your retirement accounts. They're going to have some volatility involved, ups and downs, but they're built for long-term wealth accumulation and growth. Some are going to be kind of on the shorter end. Those are a little bit more oriented towards some kind of income that you might need, some kind of preservation that you might need, some kind of just smaller, not quite as much growth, but, still earning, having your money work hard for you. And so and then there's going to be pieces that are for college funding. There's going to be pieces for legacy planning, all those different things. And I think it's important to remember that every investment portfolio or every investment has a particular job to do. And how we put those together or build out that portfolio is putting a good team together, right? So we have a well experienced investment committee. That's certainly the three of us. Plus then also, we have Andy Voss in our office that helps us. And then we have some outside resources that we rely on that have, many years of experience in building portfolios, monitoring portfolios that we utilize that help us, construct what we call is our investment policy It helps us define risk parameters. It helps us establish those asset allocation targets. It helps us also to decide in advance how we're going to react during market stress. All of those are on the table at our regularly scheduled investment committee meetings. And I feel like we've got a really good group of individuals to help us manage clients' portfolios. I think the kind of the second piece of that is how do you manage risk? And risk we're not just talking like there's a couple different types of risk. We're not just talking market movement, but we're talking about like sequence of returns risk, right? As you're doing your investment planning, those are important. If you retire and all of a sudden you have really good years in sequence, all of a sudden that's going to help out your retirement portfolio in the future. Or if you retire and all of a sudden you've got a few years of struggling where the market struggles, that's going to make some changes. So that's definitely a risk that we have to monitor. Obviously, the inflation risk, making sure that your dollars are growing and they're able to provide you income in the future. Um, all those can be handled with some different asset strategies or asset allocation to help mitigate some of those risks. They don't eliminate it, but they can definitely mitigate those risks. And we'll also touch on real quick, we like to run our clients through a program, a risk analysis program called Nitrogen. And what that does is score every single investment possible, 1 to 99, 1 being the least amount of risk, 1 being the most amount of risk. And it pools all those different investments as we build out our portfolio. It gives us a composite score for our model, right? And then we will ask a series of questions and run clients through a questionnaire and find out what their risk score is. And then we just marry up what their desired risk score is with the portfolio model that scores best for them. So maybe they come out to be a 60, then we're going to put it into a portfolio that has a risk score of about 60. And I don't know about you guys, but that certainly eliminates a lot of questions during you have markets both ups and downs when you're looking at, this is our desired risk. Our portfolio is acting exactly like we thought it would. And, therefore there should be a little bit more comfortable, during those market volatility times. And I think the third piece, for the mindset change is how do you behave during market volatility? And, because that happens, right? We know that at sometimes every 12 to 18 months, you're going to have a decent correction, whether that, might be the market dropping by 10% or 20%, who knows? But we know that it's going to have some kind of pullback. Usually it just doesn't go up in a straight line, perfect forever. How do you react during those times is really, you know, going to affect your portfolio certainly in the future. And I think for us, as we've talked about our investment committee, and Ethan, you touched on it earlier, is we do a lot of tax loss harvesting, right? So if we have a situation where you're in a taxable account and a portfolio position is down, we will, harvest that loss and reinvest it into another investment that's going to act similar and take those losses and either offset some future capital gains or be able to write a little bit off of your tax return in the future. And that strategy in itself has saved clients, thousands of dollars, in tax returns. Another thing is we like to call it opportunistic rebalancing. And I think that's an opportunity where the market has certainly pulled back and inside those jobs and all those portfolio pieces doing their job, one of them isn't down as much. So you might take that one and trim out that position a little bit and put it into a position that may be down a little bit more than everything else, but you feel like you have some conviction. You feel like that's an opportunity to buy at a little bit lower price than normal, and that will could potentially have higher returns than the rest of it when the market ultimately does recover. So again, I think I'll leave again, kind of going back to that mindset change. Don't always ask that question, what did my portfolio return? But kind of shift it around is like, is my portfolio helping me live the life that I want, now and certainly into the future?
Very good. Yep. I think that's all good points there, from a tax management and from, investment management standpoint. And I think if we're going to go to this third leg, which is going to be estate planning, I think a lot of people just think of estate planning as, hey, you got to put together a trust, you got to put together a will, you've got to do this and that. But I think there's a lot of other things that go into it. And a lot of it coincides with the investment management and the tax management piece of it, right? So when you think about um, estate planning, it's more than just wills and trusts, right? So it's about protecting your family. So when you think about protecting your family, that's making sure that you've got beneficiaries named properly on every single account. As well as if it's not a retirement account, you've got a transfer on death named on there so that you know that that asset's going to somebody and hopefully is avoiding probate. But then the other thing when you think about protecting a family is most families have some sort of an insurable risk, right? So when you think of insurable risk, it could be the fact that you're a young family, you've got a big mortgage, you've got all these expenses, and in general, if one of the spouses passes away, there's a huge liability there that needs to be covered, and life insurance would be the way to do that. If you think about disability, a lot of people don't realize that their biggest asset in their life is their ability to earn income. Okay, so when you think about that, you think about disability insurance, making sure that if somebody becomes disabled, that it's not going to completely cut off their income stream as well. And then, lastly, long-term care. And this is one that's tricky, is that people have an insurable risk as you think about somebody's full estate plan. Well, one thing that can derail that estate plan is if somebody goes into a nursing facility for a very long period of time. That can be very, very costly. That can drain a lot of money out of somebody's estate as well. And then when you go down the road of estate planning, what happens if you become incapacitated? You need to make sure that you are choosing who you want to make all the decisions for you, and that goes with medically, financially, and everything in between there as well. So that's part of your estate plan as well. And then, lastly, I think with estate planning is when we talk about some of the things Eric was talking about, some of the things Ethan was talking about, specifically with Ethan, when you're talking about tax management, I think there's a big, uh, tendency for people to think of tax management as, hey, how am I going to save money on taxes this year? Right. And the reality is there's also estate planning, or I'm sorry, tax management for your estate plan. Okay. If you think about, and a good example of that is if you have a lot of traditional IRA money, and you pass away, your beneficiaries are going to get that. They're then going to have to drain that over 10 years, and they're going to, basically have to pay taxes on that as it comes out. Whereas when you think about a Roth IRA, if someone passes away with a Roth IRA, their beneficiaries also get that. They have to drain it over 10 years, but there's no income tax on it. So what are the strategies in your lifetime that we can do to get maybe more money from a traditional bucket to a Roth bucket, and a number of other things that we can do during your lifetime to hopefully help your estate pass down to your heirs on a more, tax efficient basis as well. So I think when you look at all three of those buckets from a personal CFO standpoint, and I don't know about you guys, I feel like we probably hit on 20 to 30% of the stuff that we could actually hit on today when it comes to that. But when you think about like the quarterback, personal CFO, I think that's a really good thought process when you're hiring a financial advisor. If you're going out and the financial advisor is only talking about investment management and risk tolerance, well, that's an important piece of what you're doing. But what about the tax management of that? And if they're only talking about tax management, well, that's important. But is that actually conducive with your investments and your estate plan and all that? When you hire someone that's a more holistic planner, aka personal CFO, I think you have somebody kind of quarterback in that situation. Doesn't mean you don't still need other professionals to help out, but you have somebody kind of leading the charge and helping you hire all these other professionals and make sure that everything's working with each other. So, what else we have to add, guys?
Just think last thing I'll say is transparency is key. Be transparent with your team, with your advisor, with your CPA, with your insurance guy, with your estate planning attorney. Make sure they know everything that you know. Don't try to hide things, because if that could rear its ugly head in 10 years, right? So the more we know, the better we are at our jobs. And I think I speak for all the other financial professionals out there. The same goes for them as well. So just be transparent. Coordination is key. I'd rather solve the problem early than solve the problem late. So trying to get ahead of some of that stuff.
Absolutely. Well, awesome. Well, this has been a great time. We're right at 20 minutes. So this is one of our shorter long form ones. And I think we covered a lot in that 20 minutes. So appreciate it, guys. And this is Metcalf Money Moment signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.